What if the CRA took 25% of your estate before your family ever saw a dollar? Well, if you own real estate or you operate a business or you hold corporate investments in Canada, your estate will probably face massive capital gains taxes at death. But there's a smarter way to protect what you've built. Hi, I'm Laurent Munier. I'm a partner and advisor here at Safe Pacific Financial in Vancouver, and in today's video, I'm going to show you how corporate-owned life insurance can take care of your capital gains tax problem, how it can bypass probate, and it can help your family inherit more of your wealth tax-free. What is corporate-owned life insurance in Canada? We have a full video that you can find in the description or on the screen right now, but corporate-owned life insurance, or COLI, is a specialized financial tool that allows your business to own, fund, and benefit from a life insurance policy on the life of a key shareholder, probably you, the owner. But unlike personal life insurance, corporate life insurance is not just about the protection. It's about a strategic wealth planning. It's about tax efficiency, and it's about intergenerational wealth. Here's how it works. So your corporation owns the life insurance policy. The company is both the owner and the beneficiary. The premiums are paid using those corporate after-tax dollars. So those are usually taxed at a lower rate than your personal income. So it's a more efficient use of capital. The policy accumulates a cash value over time. So these permanent policies, specifically the participating whole life, allows funds to grow on a tax-deferred basis inside the corporation. And then when you pass away or when the shareholder passes away, the corporation receives the tax-free death benefit. The benefit is paid directly to the corporation. It's not taxed as income, and it can be credited to the Capital Dividend Account for a tax-free distribution to the shareholders or to the beneficiaries, obviously minus the adjusted cost base. There's no capital gains, there's no probate, and there's no forced liquidation. You don't have to sell something to pay other taxes. This makes corporate-owned life insurance one of the most powerful ways to transfer wealth efficiently while protecting your business and your estate from tax erosion. In Canada, corporate-owned life insurance is widely used by incorporated professionals, by business owners, often in a holding company. And the reason why is to offset future capital gains on death, to create a tax-free estate liquidity, to get retained earnings out of the company efficiently, or to fund a buy and sell agreement between shareholders, or to have like some sort of buyout system, and to build a guaranteed tax advantage reserved for future opportunities as you build up this cash value. So at Safe Pacific here, we specialize in helping Canadian business owners to structure these policies correctly, to have them aligned with their corporate setup, to have it aligned with their retirement goals, and to have it aligned with their estate plan. Now, why is this corporate-owned life insurance such a powerful tax strategy if you've got your business here in Canada? Using it isn't just about protecting the business. It's about creating a tax-efficient vehicle for estate liquidity, for capital gains relief, and for wealth transfer. So this is why the strategy is so effective when you're incorporated here in Canada, whether that's you're an incorporated professional or you own a business. So number one is the tax-free death benefit via your Capital Dividend Account or your CDA. So when your corporation receives the life insurance death benefit, the proceeds are not taxable as income. So even better, when you take away the adjusted cost base, your ACB, whatever that remaining amount is, credits your Capital Dividend Account. So it either creates it or it increases it. The CDA allows the company to pay out a tax-free dividend to the shareholders or the beneficiaries of the company. And then this creates immediate estate liquidity. So this is money that can be distributed without triggering additional tax and without additional delay. So this means that your family gets access to the money quickly and efficiently and outside of probate, which probate could otherwise tie up your estate for months or years, depending on how smooth everything goes, and also depending on how busy the courts are right now. So just this makes this corporate-owned life insurance one of the most tax-advantaged ways to transfer the retained earnings from your business to your family smoothly and quickly. Number two, you can offset the capital gains tax without selling your business or without selling other investment assets. So when you pass away in Canada, the CRA treats almost all of your assets, so like your business shares, real estate, investments, as if they were sold at fair market value now. And this is called a deemed disposition, and it triggers capital gains tax, even if you didn't actually sell whatever it was. It's a deemed disposition. You don't have to sell it, but they deem it sold. And then if your estate doesn't have the cash to cover this tax bill, the heirs, your next generation, might be forced to sell. So they might be forced to sell your business. They might be forced to sell your real estate or your rental properties, or they might be forced to sell other investment portfolios or private equity positions. When you have a corporate-owned life insurance policy, the estate doesn't usually need to liquidate anything because the tax-free death benefit creates this instant cash injection. So then your family can use that cash to cover the taxes and to keep control of these assets that you want to keep control of, whether that's the real estate or the business or you have another portfolio. And this can help to preserve the legacy that you built because you have the insurance that pays out tax-free. Now you have cash. And when the CRA says, pay me my tax, you can use this cash from the insurance to pay them. Third, you can preserve access to your small business deduction or your SBD. So under current Canadian tax rules, we have this passive income rule, the passive income tax, which says that inside the corporation, any passive income over $50,000 a year can then erode your small business deduction. So losing your small business deduction could increase the tax on your business's active income by up to 13%, depending on what province you're in. So if you lose your small business deduction, you may be paying up to 13% more in tax on your operating business. So this is a significant hit and you probably don't want to do it. So here's the advantage. If you have cash value growth inside a permanent life insurance policy, this doesn't count as passive income. So it doesn't affect your small business deduction. So this means that you can grow this corporate asset in a tax efficient way without jeopardizing that lower small business deduction rate. And it's one of the few ways to grow your retained earnings inside the holding company or inside your corporation without triggering a tax consequence. Here's a step-by-step strategy. How do you use the corporate-owned life insurance to transfer the wealth tax-free? So setting up the corporate-owned life insurance strategy in Canada, it involves more than just buying a life insurance policy, right? You got to be thoughtful about this, and you have to think about this thoughtful, tax-efficient plan that integrates with your corporation, that integrates with your estate, it integrates with your long-term goals, it integrates with your family. So here's how it works. Number one, yes, you do need to be qualified for and purchase a permanent life insurance policy that's going to be owned by your corporation, or you're ideally going to be owned by your holding company, maybe owned by a trust. The foundation of the strategy, it's a permanent whole life. Usually we're using the participating whole life policies, and it's not a term policy because we don't want it to expire and you do want it to have a cash value. So it's going to be owned by your corporation, like I was saying, probably your holding company, and then you're going to fund it using the retained earnings, which will be taxed at a lower corporate rate compared to your personal income. If you had to take the money out of the corporation, pay yourself, pay tax, and then pay for the insurance, versus you buy the insurance in the company with after-tax corporate dollars. So what this does, it's designed to provide both insurance, which you need, and this growing asset base inside the company. And this allows you to use these corporate dollars, which are taxed lower, to fund your estate and your succession plan, and also your protection today when you need it. And this is generally more efficient than paying yourself an income and using personal after-tax dollars. Next, you want to pay those premium using retained earnings from the corporation. So the corporation pays the premiums from the retained earnings, which provides a few different advantages. So number one, it keeps your personal cash flow for your lifestyle and for your investments, right? You're not tying up your personal money. It also avoids the needs to withdraw the funds from the company personally and trigger the personal income tax. So it's just cheaper to leave it in the company. And it builds this asset inside the corporation while using these lower taxed corporate dollars, right? And then this is again one of the reasons why we recommend to hold it inside the holding company, because then the asset is inside this holding company that you're probably not going to sell, right? Like if you had this operating company and you sold it or you wound it down, what do you do with the life insurance? So solve that problem, don't put it there, put it here. The approach helps to redirect this capital, which is sitting inside the holding company, your retained earnings. It's now growing, it's growing safely. You don't need to worry about it. It doesn't affect your passive income rules. It's tax efficient, it's tax deferred inside there. And it's just an asset that just sits there and gets bigger. And then eventually solves your estate needs. So third, you just wait and you watch your cash value accumulate over time. And obviously you're paying the premiums every year. So as you fund it, this is building a guaranteed cash value inside the policy inside your holding company. So the cash value grows on a tax deferred basis. You can access this cash value via loan. So depending on how we set this up, it'll either be a policy loan from the insurance company, or it could be a collateral loan from a bank. It doesn't count as passive income under the CRA rules, which can help to keep your small business deduction depending on how much money you make in the corp. And it can act as a source of emergency liquidity or future capital for your business, or even potentially for personal use. You're building this tax-advantaged corporate asset that also protects your estate. And you're doing this all inside either your holding company, your trust, sometimes your operating company, but generally not. And then 4, when you pass away or when an important shareholder passes away that's insured, the corporation gets this tax-free death benefit. When this insured shareholder passes away, the full life insurance death benefit pays to the corporation tax-free. So you get the entire death benefit amount. And this creates immediate liquidity to cover estate taxes, capital gains, other financial obligations. If that important shareholder passes away, it's probably going to negatively affect the company, so it can pay for things like it can keep the lights on. And then it allows this business or the holding company to remain full and to remain intact without needing to sell assets or dip into investment portfolios or sell real estate to pay taxes, right? Because you now have this insurance. And then minus the ACB, that remainder amount can pay out to your shareholders or beneficiaries in a tax-free way. And it's one of the most efficient ways to generate this estate liquidity, which really reduces your risk of having to sell assets at that time. And then number 5, the amount above the policy's adjusted cost base, or ACB, gets credited to the Capital Dividend Account, or CDA. So your ACB of the life insurance policy is going to decline over time. So it depends on how long you have the policy. And when you die, whatever the difference is between your death benefit and the ACB, that gets credited to the Capital Dividend Account. So usually it'll take, well, it depends on how old you are and depends on how long you have the policy, but it's going to be 20, 30, 40 years. Eventually your ACB is going to be 0 and the entire amount can credit the CDA. But we don't know when that's going to be because we don't know when you're going to pass away. So we can't promise that right now. But if you keep the policy for long enough, eventually it will become 0. And then again, your CDA, this is a notional account that allows this tax-free distribution to the shareholders. And then your estate, your family, the corporate beneficiaries, they can get the proceeds of the CDA without triggering personal income tax. So it makes it an ideal tool to get the wealth out from the company tax-free. And then 6, you want to pay out a capital dividend to the shareholders or to the estate, and you can pay this out tax-free. So once the CDA is credited, then the corporation can distribute this capital dividend. So you can either distribute it to a surviving shareholder, to a family trust, to your estate, depending on how you're structured. And then the dividends are fully tax-free. And this lets your family or to whoever the successors are to get this liquidity quickly with no tax and without going through probate. And then 7, whatever the remaining corporate assets are, they can pass smoothly to the heirs. So because the life insurance proceeds creates this liquidity, it gives you money right now to cover taxes or to provide income. Other assets like an operating company or real estate or an investment portfolio, you don't need to touch well, not you, you're gone, but the next generation doesn't need to touch those. So you don't have to sell under pressure. You don't have to liquidate when the market is down. You don't have to battle CRA over estate taxes. You don't go through probate. You don't have to wait for your provincial court to go through probate. And then your beneficiaries can get a clean, well-structured corporate entity with long-term value in it, right? They get the money to be able to pay the taxes. They get the money to pay for stuff that needs to get paid for right now. You know, maybe you just need to pay the hydro bill on the building, whatever that is. And so this is what we do all day, every day. At Say Pacific, we help these types of people, high net worth families or incorporated Canadian business owners or incorporated professionals, how to structure these plans from start to finish. And then where we are a little different than other advisors out there, we will actively coordinate with your accountant, with your lawyer, with your estate team to make sure that everything flows the way it's supposed to, that everything's documented, that everyone has the numbers that they need, and that this is maintained on an annual basis, because all these numbers are going to change every year as you add more money, as the dividend grows, as you get older, as the value of your business and your real estate all changes. All these numbers are changing all the time. So you need somebody who's on top of it just to manage this and service it over time. Now, let me give you a quick example of using corporate-owned life insurance so that you can maximize your estate value. I will walk through a real-world case study that shows how this corporate-owned insurance can significantly outperform, say, a traditional corporate investment, because it'll minimize the taxes and it'll maximize the estate value. We're going to talk about Dr. Tracy. Tracy is 43 years old. She's incorporated. She's a professional. She's a consultant. And like many high-income professionals, she's got retained earnings inside her holding company or holdco. And she wants to grow this money for the estate, but she also doesn't want to get taxed too much. She doesn't want to take a lot of investment risks, so she's not super excited about investing in the market. And she is concerned about how the wealth is going to transfer to her family. And so here's how she put up against two common options. So option number one was invest in the retained earnings into a GIC. So she puts, say, just for example, she puts $10,000 a year for 20 years into a GIC that's held in a corporation. And these GICs are earning 4%, which is then taxed at the top passive income corporate tax rate. So for her, it's going to be around 50% because that's where she lives in the province. After 25 years, so she's going to be 68, the net estate value of the GIC is going to be around $174,000 after taxes. So, GIC is a very low risk investment, but massive tax drag, massive tax on passive income. This limits the long-term growth. And there's no estate benefit. So there's no tax-free death payout or there's no bypassing probate, right? A GIC is good, it's safe, secure, but not a lot of other advantages. Option number two, you can invest the same amount of money into a corporate participating whole life insurance. So here, Tracy instead puts $10,000 a year for 20 years into a participating whole life insurance policy that's owned by the holding company. The policy grows tax deferred over time. It gets a dividend from the insurance company. And then when Tracy passes away sometime in the future, we don't know when, we're just using 85 as a year here, the corporation receives that full death benefit. So let's say in this example, it's going to be around $400,000 when she passes away at 85. So this death benefit goes through the Capital Dividend Account, which allows the family to get the money tax-free, minus whatever the ACB is. But because she's going to own this policy for so long, we're estimating that the ACB is going to be zero by that time. By using the corporate-owned life insurance, this is what happened for Tracy. She more than doubled the estate value compared to having her money tied up in these taxable GICs. She's eliminating the capital gains and the income tax on the growth, right? So as this insurance policy grew, it wasn't getting taxed. And then she's able to transfer the wealth to her family tax-free through this capital dividend account, which then provides liquidity to her estate. It doesn't go through probate. There's no delay, and her family doesn't have to sell anything to pay the taxes. And then why does this work so well in Canada? This strategy takes advantage of multiple tax planning advantages. So number one, you've got the lower corporate tax rate on the retained earnings. So when the money that you're using to pay the policy, you're paying corporate taxes versus personal. Then you've got this tax deferred growth that's inside the life insurance policy, right? So as the policy is growing with the dividend, you're not paying tax on it. Then you got the tax-free payout. So the tax-free payout first to the corporation when she passes away, and then the tax-free payout through the capital dividend account to her beneficiaries when she passes away. Then you also have no exposure to capital gains, no exposure to your passive income rules. It doesn't go through probate. So you don't have any sort of delays there. It doesn't have to go through court. Important considerations when you're using corporate life insurance policy. Everything I've told you right now is great, but what do we need to look out for? So it is a powerful tool for tax efficient estate planning and for wealth transfer, but you do need to understand the nuances involved so that you don't have any sort of unintended consequences. And now here's some key considerations. So number one is you need to know what is your adjusted cost base, because the adjusted cost base reduces the CDA. So when the corporation receives the life insurance benefit, the amount that gets credited to your capital dividend account is reduced by whatever your adjusted cost base is. So the ACB, it reflects the cumulative premiums that were paid into the policy minus adjustments over time. And eventually it'll hit zero, but because we don't know when you're going to die, we don't know if it's going to be zero at that time. So this means that you need accurate tracking and record keeping of the ACB. And this is, again, where you work with somebody like us. This is what we do. So you don't have to do it. You just ask us for the numbers and we send it to you. We send it to your accountant. You also need proper documentation, because without proper documentation, you might not be able to fully leverage the CDA's tax-free payout advantage for the estate, right? So your accountant needs to track the CDA. It needs to track anything that increases your CDA and anything that decreases your CDA. And we've got full other videos that only talk about CDA that you want to see, 5 or 6 things that can increase your CDA and 5 or 6 things that can decrease it. So what we do at Say Pacific, we work with your insurance company, we work with your accountant so that everybody has updated ACB values throughout the life of the insurance policy. Second, there could be an impact on your lifetime capital gains exemption. So if the corporate-owned policy accumulates way too much cash value, it could be classified as a passive asset. So generally, again, you work with somebody like us so that we make sure this doesn't happen. But this does really matter if you're going to claim the lifetime capital gains exemption when you sell shares of your company, your qualified small business corporation. If too much of the company's assets are considered passive, those shares could fail to meet the qualified small business criteria, right? So this could possibly disqualify you from getting your lifetime capital gains. Again, this is why you want to work with a good accountant. This is why you want to work with a good insurance advisor like us so that we make sure this doesn't happen. If it does happen, it could result in losing basically access to $1.25 million in tax-free capital gains when you sell eligible shares of your business. And again, you want to have the right proper asset mix. You want to have the right policy management correct. You want to have all your numbers correct, especially if the future business sale is part of your exit strategy or your succession plan. And then third, you want to have your ownership structure correct because the ownership structure matters. So most successful implementations of a corporate-owned life insurance policy involve setting up the policy inside a holding company, not in an active operating company. So the holding company can limit liability and it can isolate or it can put a firewall between your passive assets or your savings or your retained earnings from your operating company. So if something happens in an operating company and somebody sues it or goes after it, they can't go after your holding company. So you're protecting yourself. It also gives you more flexibility for estate planning. It also gives you more flexibility for an exit. Because say you want to sell your operating company, does the other person want to buy this giant life insurance policy on you? Probably not, right? So you put it in the holding company so that it doesn't clutter up the operating company. When you do it correctly or incorrectly, putting the policy in the wrong corporation could have tax liabilities. It could reduce your creditor protection, or it could complicate distribution of funds when you pass away or when you sell the company. Again, if you don't have the holding company set up right now and you've got an operating company, it's not the end of the world. Because you could eventually transfer it from the operating company to the whole company, you just don't want to do it too late. You don't want too many years before you do that. So if you got the operating company now and you're setting up the holding company within a couple of years, set it up here, it's fine, and then we can move it. You just don't want to move it later once the insurance policy gets too big and then it's too expensive to move because you're actually transferring this asset. So anyways, at Say Pacific, we work with your accountant, we work with your lawyer, we work with whoever's doing your estate plan to ensure that the structure is sound, to make sure that everything's compliant, to make sure all the numbers are correct and all of the values of the investments, of the insurance, everything's tracked and optimized for whatever your long-term goal is, right? And then eventually for your generational goals. Now, how do you build this tax-free legacy with the corporate-owned life insurance? We'll just do a quick recap. It's more than just a protection tool, which it obviously is. It is a strategic financial planning vehicle that helps Canadian business owners. It helps incorporated professionals to preserve and to protect and to transfer their wealth in the most tax-efficient way possible. When it's properly structured, the corporate-owned policy, it can eliminate or reduce capital gains on death. It can eliminate or reduce capital gains on your business shares, on real estate, on corporate investments. It creates immediate tax-free liquidity to the corporation and to the beneficiaries through your Capital Dividend Account, which could cover estate costs, it could cover other taxes, it could cover other obligations, or just things that you need to pay for. Or not you're gone, but things that your estate would need to pay for. It can bypass probate. So it bypasses those delays, it bypasses that administration, it bypasses those fees, it bypasses the errors that can happen, it bypasses all that responsibility, which ensures a faster, cleaner wealth transfer to your beneficiaries. It can protect your retained earnings because you're using your corporate dollars, which were generally taxed at a lower rate, instead of withdrawing from the corporation or paying yourself an income and paying personal income tax. So whether you're planning to retire, whether you're selling your business, whether you want to leave behind a meaningful legacy, whether generational wealth is important to you, the corporate-owned life insurance is a powerful solution that can safeguard your life's work without triggering capital gains, without forcing asset sales during a difficult time. Now, is this strategy for you? I have no idea. We've never met. But if you are a Canadian, if you're a business owner, you've got retained earnings, you've got a holding company, or you're an incorporated professional, you've got significant corporate investments, maybe you're a real estate investor that's got appreciated assets, or maybe actually more often than not, maybe your parents have real estate that they bought a long time ago. They bought a few buildings or they got rental properties, and those have gone up significantly in value. Maybe you're an incorporated entrepreneur, and so you're already thinking about the estate plan. You're thinking about generational wealth. Then this corporate-owned life insurance might be one of the smartest financial moves that you can make. This is what we do all day, every day. We really specialize in helping high-income, incorporated Canadians to grow, to protect, and to transfer their wealth using these tax-smart insurance strategies. We're happy to work directly with your accounting team, with your legal team, to make sure that the details are taken care of, to make sure everyone's on the same page, all your paperwork is set up the right way so that you have this thing structured properly to achieve the goals that you said you want to do, and to execute everything properly and to get it done. How do you work with us? If this is something that sounds like you, then you can go on our website. It's safepacific.com. There's buttons all over that website where you can schedule directly into our calendar. We have an online calendar system. Or you can send us a message through the contact page. There's tons of ways to get a hold of us. And the first thing that's going to happen, we're going to do what's called a discovery meeting, where we're really going to understand your current situation. What are your goals? What are your concerns moving forward? And can we even help you? Do we like you? Do you like us? And are we going to take next steps? Like I said, in order to do that, go to the website, safepacific.com, fill out the form that's there, or book in our calendar. There's also going to be a link somewhere around this video or in the description where you can do that. And then before you go, if you got value from today, please do all those things that the robots and the algorithm like, so that it can spread to more business owners who are thinking about legacy, who are thinking about generational wealth. We're a rare breed in Canada, so it's hard to find. Any clicks that you do, liking, commenting, sharing, subscribing, click the notification bell, all of those things really help. Engagement helps a lot too. So leaving a comment, even if you just leave a comment of what city are you in right now, that would be super helpful because it tells the algorithm to share this video more. That is it for me today. I'll see you next time.